A variety of multiple choice questions based on the financial statements of partnerships. Let's look at the first question, which is taken from Cambridge, June 2015, paper 1-1, number 13. Which item appears as a credit entry in the appropriation account of a partnership? Remember that the appropriation account is used in order to divide up the profits between the partners. Therefore, if we have a look at the options that are given, firstly, goodwill is entered directly into the capital account. It's not part of the profits. Although it does increase the equity, it is a direct effect on the capital in a similar way as to the way that assets might be revalued, and revaluation is also credited to the capital account. And so therefore goodwill will not be part of the appropriation at all, and we don't like A as a possible answer. If we have a look at the option B, interest on capital. Well, interest on capital is going to be credited to the current account, and appropriation will be used, but appropriation will have to be debited. So therefore, that is also not an option. C, salaries credited to the current account. So again, you would debit appropriation rather than crediting it as is required. Salaries and interest are treated in exactly the same way. So both B and C are not options. Lastly, D, profit. Well, profit increases the equity, and as a result, it would therefore be credited to appropriation, and you will use it in the appropriation account because that is the purpose, is to divide up the profits. So we will choose D as our answer. Number 14. Alice and Barty have been in a partnership sharing profits and losses in the ratio of 3:2. The balances on the capital accounts as at 31st of December 2014 are shown, and here they are. Alice 32,000, Barty 18,000. The partners decide to share profits and losses equally with effect from the 1st of January 2015. There was no goodwill in the account in the books. Goodwill is valued at $30,000 and is not to be retained in the books of account. As soon as you value goodwill, it's indicating that they do see that there is a value of goodwill that needs to be attributed to the partners. However, they want to credit the partners with that amount, but then remove it afterwards, which might seem a bit silly, but actually it's not, as you'll see after we've done a couple of these examples. Basically what happens is you value your goodwill at the old ratio and give it to the partners in that ratio, and then you use the new ratio to remove it from the books of account. And in that way you will notice that the partners actually benefit, the ones that were there before, when, for example, you're bringing a new partner in. In this situation, it's simply that they're changing their ratio of profit sharing, and then they will have a look and see how they actually benefit from that. Right, so the question asks, what is the balance on Alice's capital account after the adjustment for goodwill? What you'll need to do is obviously start with Alice's opening capital of 32,000, and then you want to add the goodwill, so you'll say plus 30,000, and you'll do it in the old ratio. The old ratio was a ratio of 3:2. In other words, Alice got 3/5 and Barty got 2/5. So to value this goodwill of 30,000, you will say add 30,000 times 3/5, in other words 18,000, and you will credit that to Alice's account. So you'll add it, you'll increase the amount that is due to her. But then you need to remove it because it tells us that we are not going to retain goodwill in the books of account, and so then you minus it. So you are saying plus 30 minus 30. The difference is in these ratios, which one you are using. The new ratio is that they are sharing profits and losses equally. In other words, they each get a half. So you are going to remove it from the books in that new ratio, in other words, as a half, which is 15,000. And you'll then see that Alice ends up with a new balance of 35,000, where she started with 32. This makes sense because in the old ratio, she benefited from a larger share, and so she needs to benefit from a larger share of that goodwill, even though it is being put in and then removed. She is actually benefiting from a little bit more before they move on to the equal sharing of profits. So 35,000 is the answer you are looking for, and you look at the options given, you will choose C. Looking at Cambridge, June 2015, paper 1-2, question 12. How should interest be charged on a partner's drawing account be treated? Well, in this case, you need to keep in mind that if interest is charged on the drawings, it's the opposite effect to where the interest is received on the capital by the partners. So what happens is that, in a sense, the business is earning this money. It's not a business income. It won't go on the face of the statement of income. But if you try and think of it as being sort of earned by the business, as opposed to where the business will pay, in effect, interest on capital, that will help you to understand that you will need to credit the account. But now, because it is not an actual business income, it is simply a way of dividing up the profits. It will go in the appropriation account. So interestingly, what will actually happen in appropriation is it will go on the credit side of appropriation together with the profit. So whichever partners have drawn drawings, they are trying to be discouraged from taking cash out of the business, and therefore they have to sort of pay in before they can actually earn their profits that are due to them. You'll therefore choose A as your option, credited to the appropriation account. 13. Kay and Lay share profits and losses in the ratio of 3:1. Capital account balances are Kay $100,000 and Lay $84,000. There was no goodwill account in the books. The partners changed the profit sharing ratio to 4:1. So this is similar to the one before. We've still got two partners, but the ratio was 3:1. It now changes to 4:1. Goodwill is valued at $54,000, but is not going to be kept there. What is the balance on Lay's capital account after the adjustment for goodwill? Again, you're going to need to put goodwill in and then take goodwill out again. Keep in mind that because no new partner has actually been introduced, nothing has actually been paid for this goodwill. So the fact that they've put in goodwill of $54,000 as a value, they can't actually show it in the books of account afterwards. Just keep that in mind. You can only show goodwill if it has actually been paid for. So wherever you have a situation that the profits and losses are simply changing and there's no introduction of new capital, in other words, no payment for this goodwill, you have to remove it from the books afterwards. So in the same way as we did previously, we will start with the new capital, with the previous capital account, and we are looking at Lay. So Kay and Lay. Lay used to have a third and then, a quarter, and then will end up with 1/5. And your start Lay has 84,000. So that's why we'll start with 84,000. We'll then say plus the old goodwill, 54,000 times a quarter, which is the 3:1 ratio, means that he got a quarter of that. And then you will subtract 54,000 times 1/5, because he needs to benefit a little bit from the old goodwill, and you'll see therefore 86,700 is what he actually has, because he is going to end up with, under the new ratio, less of a share than he did before. So the capital needs to increase to show that. So we get 86,700 as our answer. Now go and have a look at it in these options, and you can see you choose C. The next question is taken from Cambridge, November 2015, paper 1-1, number 16. Which entries are made to record interest on capital in partnership accounts? Now, in the partnership accounts, that refers to talking to the current account. So, and what we are going to do is we want to use our appropriation account in order to actually allocate this, because remember that interest on capital is not a business expense, so therefore it's a way of dividing the profit, so we will use appropriation, and the partnership accounts indicates that we want to use it in the current account. So those are our two options, appropriation and current. Now we just need to decide which one will be debited and which one will be credited. Well, the interest on capital is a way of dividing the profits, similarly to where you pay out a salary and you divide the profits between the partners, and so therefore the appropriation account will need to be debited because we are reducing the profits. Similarly, the current account as an owner's equity account must be increasing, and so therefore we will credit it. So we will then debit appropriation, credit current account. There's our answer. We will choose B. Number 17 from the same paper. Two partners, X and Y, have a capital account of $10,000 each and share profits and losses equally. They agree to admit Z to the partnership and continue to share profits and losses equally. Now, although in both cases they are sharing the profits equally, I do hope you can see that in the first scenario, the old ratio, X and Y each get a half. However, as soon as they bring Z in, they will only get a third. So there is a change in this ratio. In this case, Z is joining the partnership and will probably contribute capital. So it means that if you wanted to, you could keep capital in the accounting records, but it does tell us that there's no goodwill to start with. Goodwill is valued at $15,000, but it is not to be retained, which means that we need to subtract it. What will the balance on X's capital account be after the admission of Z? Well, we'll obviously start, if we're looking at X, the capital is 10,000, so we'll use that as our beginning amount. We'll then say plus the goodwill of 15,000 times the old ratio of a half, means that X needs to be credited with 7,500. He needs to get the benefit of some of the goodwill, as does Y, because Z should not benefit from that goodwill at all. You then need to subtract their new share of the goodwill because you're going to leave it out of the book. So you say minus 15,000 times a third, which is 5,000. And at the end of the day, the capital has now increased from 10,000 to 12,500. So basically what happens is X and Y are benefiting from the old goodwill. And although Z is going to contribute an amount of capital to the business that will determine this figure of goodwill, in fact, the actual capital at the end will be less than what Z actually contributed, because Z will have to also lose a third, in other words, 5,000. So our answer is 12,500, and you can see it here as B. Number 21 from the same paper. Information from a partnership's accounts is shown. You're given the profit for the year before interest. In other words, that is the operating profit of the business. You are then told about the interest on a partner's loan to the firm. Now, keep in mind that as soon as you see the word loan, you need to remember that a loan is a liability. It's no longer part of equity. Even though it's from a partner, we will still treat it as a liability. And therefore, this interest will be a finance cost. And so this would actually be shown on the statement of income. So to work out the profit for the year, it would be this 15,000 minus 1,000, and the profit for the year would actually be 14,000. The 14,000 would then be shown to the appropriation account. So it's at this point that you would then create the appropriation account. And in the appropriation account, you would allocate interest on capital of 2,000. And then the remaining 12,000 would be divided between the profits. Drawings of 10,000, however, doesn't actually come into the appropriation or the statement of income at all, as it is closed off to the current account directly. Let's see what is asked. Which profit figure is to be appropriated between the partners? So, over here, as I discussed, the appropriation is going to happen at this point here. In other words, you're looking for the profit for the year. So you'll take the 15,000 minus 1,000 to get that 14,000 Rand as your answer, or dollars, I should say, sorry. And therefore, C is what you would choose. We'll now have a look at the Cambridge Specimen Paper 1, number 11. In which account should a partner's drawings appear in the partnership's end-of-year financial statements? Now, we've already discussed from the question above that this drawings does not go into the statement of income. It does not go into the appropriation account. All that happens is it goes directly to the current account. So immediately we'll lose A and B as options because it's not an expense or a division of profits. It simply illustrates what the partner has already taken out in cash or in other assets. The capital account is usually used as a long-term account, in other words, for the actual investment of the partner, and so the annual drawings that are taken out day to day will not be shown in capital. capital. Instead, we would choose D as our answer because that's the one that shows the current account, which is the short-term movements in the equity. Question 12, X and Y are in partnership. Their income statement and appropriation account shows the following. You can see that you're given a number of pieces of information as we were previously. You're given your depreciation over here. Now remember, the depreciation would actually be part of your operating expenses before profit. Interest on loan, remember loan is a liability, so this would be your finance cost. You are then shown interest on capital, interest on drawings, and partners' salaries. All of those would be appropriations in the appropriation account, and then the remaining profit is what is left over at the very end. The question asks, what is the profit for the year before appropriations? In other words, we are looking for the profit at this point over here. So, because we're looking for it at that point, we are not going to concern ourselves with the depreciation nor the interest on loan. Instead, we're just going to work back from our remaining profit, add back all of these appropriations, and we will then be able to actually get our profit for the year. The easiest way to do this is to actually draw up a rough T account for appropriation to see how this is done. We enter in all the information that is given with our interest on capital and partner salaries and remaining profit on the debit side, as those that are the amounts that are credited to the partner's current accounts. And on the credit side, we will show the interest on drawings that has been charged. The missing figure here is then the profit for the year that would have been brought across from the statement of income. And this amount would have been after the depreciation and interest on loan. Let's have a look if it's one of our options. We are looking for 18,500, and you should be able to see there A is the answer that we are going to choose. 13. X and Y are in partnership with combined capital and current account balances of 125,000. Z is admitted as a partner, introducing capital of 40,000. At that time, the assets of the partnership are revalued upwards by 50,000, and goodwill was valued at 18,000. Goodwill was not to remain in the books of account. So again, you would put the goodwill in, but then you would take it straight out. What was the total capital employed of the partnership immediately after the admission of Z? Now, the total capital employed means the total amount of money that is actually available to the business. So obviously what we'll do is we'll start with this combined capital and current account balances of 125,000. In other words, that is the equity at the beginning of the period, and we are looking at total equity. So we'll start with 125,000, and we'll then add the 40,000 that Z contributes in cash or other assets. We will then also need to add on $50,000 for the revaluation of the assets that were there. We would then add 18,000 goodwill, but we would also need to subtract 18,000 goodwill. So if you wanted to, you could actually show over here a plus 18,000 minus 18,000 for goodwill, but you can see it cancels itself out. So you don't actually need to show it. Sorry, that should be 18,000. So you don't actually need to show this at all, but if it helps, by all means go ahead, because you are adding it and then you are subtracting it. Because you are doing the total equity or the total capital that's been used over here, you don't need to show the ratios, and that is why it actually will just have a null effect. So your answer then is going to be 215,000, which you can see is given as option C. Number 15, X, Y, and Z are in partnership and they have the following assets and liabilities. You can see a number of things are given here. You're given your property and your fixture and fittings. Those are your non-current assets. You're given closing inventory and trade receivables, which are your some of your current assets, and your bank overdraft, which is obviously a current liability. You are then asked, you were told the partnership was dissolved on the following terms. So X took the property and half the fixtures and fittings, remaining fixtures and fittings and inventory was sold, and receivables was paid in full with the exception of one debt. Total costs of dissolution were $2,500, and what was the loss? Well, in order to work out a profit or loss on dissolution, the easiest thing to do is to draw up a realization account. Now, remember that the realization account is very similar to an asset disposal account that you would have drawn up when you sold or disposed of any non-current asset. And you would show the asset at cost on the debit side and the accumulated depreciation on the credit side to close off those accounts, or in effect you're putting the carrying value in on the debit side. You show what you received on the credit side, and then you can work out the profit or loss as a missing figure. We're going to do exactly the same thing here, except that instead of doing it for just one asset, we are actually going to do it for everything. However, we are going to ignore bank. When you are drawing up the realization account, you don't need to show cash or bank in there, as quite simply your bank or cash you have already got. You don't need to realize anything from it, and your bank or cash figures will simply be used to close off your capital accounts later on, and it should all balance out. So the realization account will need to have these asset figures transferred directly in on the debit side. These are the carrying values as we were shown over here, and you can see we just copy them in. We pop them in exactly as is. We can then use the dissolution information. X took the property and half the fixtures and fittings. We don't need to worry about the fact that it was just half the fixtures or fittings or what it is. The important thing is that X is taking out $560,000. And although it's not in the form of cash, it's in the form of assets, that's absolutely fine. What it means is that we are actually going to credit realization with capital, because X's capital account will be debited by that amount as if he had taken cash. We are then told that we receive cash of $140,000 for fixtures and fittings, so we can show in here bank $140,000, and then we are also receiving money for our receivables, and so we'll show in the amount that we received. Now, it tells us they were paid in full with the exception of one debt, so that means that of this trade receivables of $45,000, you received $45,000 less the bad debt $4,700, so the actual bank figure is $40,300. If you wanted to, I suppose you could put the $45,000 here and the bad debts over there, but in my mind it makes much more sense to show the actual amount that you received over here, and so that's what I would do. Loss on dissolution is going to therefore be, the cost of dissolution you need to put in first. The $2,500 can come in on the debit side over here, and then you show the loss on dissolution as a missing figure. You can then find that as your answer, and you will see that it is option D. It's always lovely when your answer comes out as an option. You can't always assume that it's right, but there is a good chance. Right, let's move on to the Cambridge March 2016, paper 1-2, question 13. P joined the partnership of G and H. He brought into the business the following assets. He brought in non-current assets that had cost him $25,000 but were valued at $38,000. He brought inventory that had cost $6,000 but is valued at $4,500, and cash of $20,000. There was no goodwill arising when P joined the partnership, which certainly does make things a little bit simpler. We want to now know what was the balance on P's capital account. Well, quite simply, we're going to credit P's capital account with all these things that he has contributed. However, it's very important to notice that we don't care what it cost him. We worry about what we valued it at. So if we valued it at these amounts over here, that is what we will consider to be his capital contribution. So it would be the $38,000 for non-current assets, the $4,500 for inventory, and the cash of $20,000 gives you a total of $62,500, which you can then see as option D. Question 14. X and Y have capital accounts of $50,000 each and share profits equally. They plan to admit Z into the partnership. The new profit sharing ratio will be 2 to 2 to 1. Now just pause here a little bit and notice that this is X, Y, Z. If you ignore Z for a little bit and you just look at X to Y, you can see it's 2 to 2, which actually is the same as 1 to 1. In other words, between the two of them, they've got the same ratio, but suddenly they are going to give Z half of what each of them have got, or a fifth of the total, and each of them will have 2/5. The balances on the capital accounts will also be in this ratio. Goodwill is valued at $20,000 and will not be retained in the books of account. How much cash will Z need to pay to join the partnership? Now, Z will need to pay a half of whatever X and Y have after you've taken your goodwill into account. So the first thing you need to do is look and see what goodwill they are going to actually get. Whether you do X or Y, it's exactly the same because they are equal partners. You'll start with their 50,000 Rand capital, and you will then add 20,000 times a half share, which is the old ratio, is 10,000. In other words, X and Y, after taking account for the goodwill, must have 60,000 in their capital accounts. Z, therefore, will have half of this, which is 30,000 that he will need to put in. What will happen thereafter is that all three of them will have the goodwill removed in the ratio 2 to 2 to 1, and they will then stay in exactly the same ratio in the capital accounts. But Z is in effect paying a little bit more than the others had paid previously because he's paying for that goodwill. So the option we will look for is 30,000, and we will choose D. Question 15. David and Jane have been in business in partnership for several years, sharing profits in the ratio of 2 to 1. Remember that if they speak about David and Jane, first, second, the ratio here is referring to them in the same way, in which case David is 2 and Jane is 1. Jane now wishes to retire. Her capital account amounts to 15,800 and her current account shows a debit balance of 3,500. So she is entitled to her capital and her current account. However, because current account has a debit balance, in actual fact that means it's in minus. She's drawn more than she should have. So where they're asking us later on what is the amount due to Jane on her retirement, we are going to have to say 15,800 minus 3,500 because it was a debit balance. Goodwill is valued at $6,600, and the book values of certain tangible assets are to be valued upwards by $3,000. We need to take both of these things into account. Whether or not goodwill is still kept in the books later is irrelevant to Jane because Jane will have left by then. But she is due to benefit from this 6,600. So you will add 6,600 to her accounts in the ratio of the 2 to 1. In other words, she gets a third. So she needs a third of that goodwill, or $2,200. Similarly, when the tangible assets are valued up by 3,000, she needs to benefit from a third of that, or 1,000. You then add all of those together and obviously subtract the current account, and you'll get 15,500 as your answer. The option A will then be the one that you choose. Question 16. Which is not an appropriation of partnership profit? Similarly to all the questions we've had previously, if we just have a look at these, you should realize by now interest on capital, because capital is equity, the interest is part of the appropriation. Similarly, B, drawings is part of your equity, and therefore the interest on drawings is going to be part of appropriation, although it will go on the credit side in appropriation together with the profits. Interest on loan is not going to be an appropriation because the loan is a liability, and therefore the interest on that loan will actually be a finance cost. So C is certainly something that we could consider, but before you choose it and just move on, check that you're happy that number D is not what you want to choose. Share of profits, well, that is obviously an appropriation of partnership profit, and therefore it does not suit our answer. So we will in effect choose C as our answer for 16. We'll now have a look at Cambridge, June 2016, paper 1-1. Number 14. The statement of financial position showed the following balances at the 31st of December 2015. We are given figures for the capital accounts of X and Y, and we are also given the figures for the current accounts. Notice that X has a debit balance. In other words, this 1,000 over here is a minus. Net assets on the 1st of January 2015 were $14,000. Now, we need to quickly check our dates. The $14,000 is on the 1st of January 15, and these balances are all on the 31st of December 2015. In other words, these are my end balances, and this 14 is my beginning balance. It's very important to make sure that you do get your dates correct. Property has been revalued upwards by $12,000 during the year, and no drawings had been made. The question asks, what was the profit for the year ended 31st of December? Now, the easiest way to work this out is to actually just recreate an account for your net assets, which is exactly the same as your total equity, in other words, your capital and current account. So it doesn't really matter what you call it, as long as you realize they are all the same thing. So in other words, where they've given us capital and current accounts over here, this is my total equity, and it's the same thing as net assets that are shown over here. So in my account, I'm going to show $14,000 as my balance brought down at the beginning. I add my capital and my current accounts. Notice that I have subtracted the debit balance of X, and I'm going to end up with a balance at the end of $31,500. I need to also take into account that there was a revaluation of $12,000. If there had been any drawings, I would have entered it on the debit side, but there aren't any, so you can leave that blank. And then your profit for the year is the missing figure. And you can see that in this case, I've calculated $5,500, and so I will choose B as my answer for this question. Number 15. Smith and Jones are in partnership, sharing profits and losses in the ratio 3:2 respectively. In other words, Smith gets 3/5 and Jones gets 2/5. We are told about the profit for the year, interest on drawings, and a partnership salary. Our question is, what was Smith's share of the residual profit? So this is asking more than just what was the residual profit to be divided between partners. You will need to work that out first, and then you will need to work out 3/5 of that for Smith. So again, we're going to use a rough T account. In this case, I'm choosing to use appropriation, because if you look at all this information that has been given, these are all items that would be in the appropriation account, and the share of the profits would then be what you would calculate in that account. On the credit side, I show profit of $152,000 as profit increases equity, and it has a credit balance, so it'll come in here on the credit side. The fact that Smith was charged interest on drawings means it also needs to come in on the credit side, because in effect it's being subtracted from Smith, 1650. Then on the debit side, I'm going to show all the amounts that would have been credited to the partner's current accounts. Firstly, the salary to Jones of $40,000, and then I'm going to work out what is left over. So although I've only shown the share of profit Smith in green, in actual fact, before I do that, I need to work out what this total amount is, the share of profit for both of them. And you'll see that your missing figure is $113,650. So I've used that for both of these guys for the calculation. Once you've worked out that total remaining profit, you can then divide it in the ratio, with Smith getting 3/5 and Jones getting 2/5. And that's how you work out that Smith would actually have 68,190. You don't need to go on and work out Jones, but if you wanted to check yourself, you could. It's 45460. And if you look at the options that are given to you, you will see that you will choose B as your answer for that question. Number 16. X, Y, and Z have been in business sharing profits in the ratio 3:2:1. So in this case, you need to have 6 slices of the pie. If X will get 3 slices, Y 2 slices, and Z 1 slice. So X gets 3/6 or half, Y gets 2/6 or a third, and Z gets 1/6. Y decided to retire at the end of the year when the balance on his capital account was 39,400. So if he is going to retire, we are going to be concerned with this middle ratio, in other words 2/6 or 1/3. On that date, the assets were revalued upwards by 57,000 and the partnership does not account for goodwill. Y took a car valued at 4,800 as part of the amount due to him. How much cash would he then get? Well, obviously you will start with the credit balance in his capital account of 39,400 and you will need to add the revaluation of 57,000, but obviously that 57,000 isn't all due to Y. So you will need to just take his share, and for that I'm using the 2 out of the whole 6th. By all means, you can put it in as a third if you prefer. I like to keep it as these numbers because then it's less confusing. So you work it out and he should be attributed with 19,000 of that revaluation. There's no goodwill, so we don't need to put it in. But if there was, we would add goodwill over here. Again, in that same ratio. We are then told that he took out 4,800, so we need to debit the account by this 4,800 against the vehicles which were drawn out, and the missing figure 53,600 would be then the amount that he is paid out. This is obviously assuming that he does not have a current account or that his current account had a zero balance, simply because they haven't given us any further information about a current account. Right, the next question, in fact, sorry, no, we are now done. We have completed this video, and I certainly hope that it has helped you understand the multiple choice questions on partnerships a little bit better. Once you've done a